How's everybody doing? On behalf of Avery, I wanted to wish everybody a happy new year, first and foremost, and many blessings for the year to come and beyond that. Today, what we wanted to do was take you through the thesis of several of our companies. So today will be part one of this journey, and then we will share the thesis on several others in another format. Now, today we will focus on 6 companies, and the point of it is to take you from kind of the market that they play in, the product that they have, the kind of valuation mechanics as we think about, is this company cheap, and essentially bringing you closer to these companies in general. So what I wanted to do was take you through a deck. You will also have a physical deck, which will make it easier to read on your own time. But we wanted to add a video version for the purpose of direction as it relates to some of the slides. So with that, I hope you enjoy the piece. All right, so here is our deck on company thesis. I think the first thing we wanted to do is share with you some of the companies that we will be going over today. So first is Fiverr, Capri, Zillow, Zoom, Omnicell, Nutanix. That's the first batch of companies we will go over here. Now, in green, what you see are some of the companies listed in green letters where they're new. They're new to the portfolio. Some of these we've held for years, in some cases 4 to 5 years. And some of the newer names that aren't as familiar to many or familiar to few, we wanted to again give you some understanding of what's going on there. Now, next to that, in the box around like structural growth transformation, we really try to describe what kind of investments these are. Are they transformation stories where the company is transforming itself to unlock value? Again, Capri is a multi-year hold for us, and that has been something that has gone through a transformation. A single brand like Michael Kors to then a multi-brand with Versace and Jimmy Choo, to then transforming both of those sides of the business for the better. Nutanix as well has gone through multiple transitions, from a business transition from selling hardware and software to selling software only, to then selling subscriptions instead of multi-year licenses. So it was an economic model change as well. And we think we're at the forefront of the end of that journey, which will hopefully unlock value over the coming years. I think from a big picture, next to that are what kind of management teams are these? So I think 5 of 6 here on this page are founder-led or founding team led organizations. And I think that's a pretty critical thing. We don't look for founder-led companies per se, but we do like organizations where the management team is aligned with their investor base. Now, in some cases, there is an operator that takes over. Think of Chipotle many years ago, which again was an investment of ours then, that went from a founder to an operator, and that was actually the best thing for the business. But we do appreciate the energy, the execution, and the alignment that a founding team does bring to the table. Now, again, for each piece, we're going to go through a couple different slides, and after that, obviously, if there's any other questions, please feel free to reach out directly to me, to Chris, and the team, and we will most certainly go through things in further detail. So let's start with Zillow, a new position for us. This is a team that has been well regarded over time. Obviously, Rich Barton has a series. He's a serial entrepreneur, successful serial entrepreneur. He's the founder or co-founder of Zillow. He was also the co-founder of Expedia and also Glassdoor. He's on the board of Netflix. He has a massive stake in Zillow itself, so he's well equipped and aligned to for any of the decisions that they make. Obviously, they made a decision recently as it relates to Zillow Offers. It was a new venture that is a couple years old that they leaned into and then leaned away from to go from kind of more asset heavy to asset light once again, and truly be this asset light marketplace for the real estate industry. Alan Parker, David Patel, again, clear leaders. Now, at some point, again, many of these individuals have been around for quite some time, and should any of them leave or anything like that, we think the team below them are well equipped to lead this organization should they position or go after different market types. Now, big picture, I think there's two key things that are benefit Zillow. One is population, and then two is the shift to digital, right? And that because the population that is maturing and growing up is just a much more digital market or demographic. So on the left side of this page, you see the U.S. population by age, and what you notice here is in that red little bar, smack in the middle, 33. 33 years old is actually the average age of a first-time buyer. In addition, we're the cohort or the demographic where the most population exists today is right in that 30 to 33 area. So what that means to us is there's a large swath of first-time buyers using historical averages of what age people tend to buy. And again, that could be early by a couple of years or delayed by a couple of years, but still a massive wave that is taking place here. We also know besides this, and it's not here, is inventory remains low, which again, massive influx of potential buyers, low inventory, higher prices. Higher prices mean potentially higher ad dollars for a company like Zillow. That's how they tend to make money today. On the right side is home search behavior, right? So what we know is studies show that 43% of buyers search online first, 18 contact an agent, and 97% of home buyers searched online for homes at some point in that journey. Now, below that, with some of the figures that we try to kind of back our thinking with data, and we always say data tells stories, and in this case, I think it's more of the same. 32.5 million downloads for real estate in 2021. So that's a large number compared to 6.5 million homes that were actually sold, existing homes. So there's a big cohort of users that are using digital today relative to the amount of homes that are outstanding. Now, the Zillow product, there's multiple layers to this. Obviously, many of you, engage with the Zillow app, and that's their core product, that's their core brand. That is going to be what drives them now and into the future. But they also own Zillow Rentals, which is a separate app, truly street easy, hot pads. So other areas and adjacent, either regional players or targeting different parts of the real estate market. So think apartments and rentals and the likes. But they also own software platforms. So they recently acquired ShowingTime, which is a pretty large CRM for realtors, and there's a million agents that use ShowingTime. And when you step back and you think about how they've made money in the past, and it's historically been ads, and you fast forward and you think about how could they make money in the future, I think ShowingTime is a pretty good indication of what they're thinking in terms of subscriptions and things like that. They also own Bridge and Dotloop and Mortec, and again, that's their moves into accumulating more data and trying to use that for the better good of the business. There's also, again, Zillow Premier Agent, which is the product for the agents. And that's generally speaking a lead generation tool. Zillow Closing Services, Zillow Home Loans. We will see over the next probably couple quarters how those play out, given that they exited the Zillow Offers business, which again turns this business into a capital intense business, at least for the last couple of years, to a asset light business. A couple more stats that I think are pretty interesting that highlight just the sheer size and success of this business and what we like to call like a moat in terms of like network effects and things like that. 54% of all the top 100 apps, real estate apps that were downloaded in 2021, 54% of all that download came through Zillow brand. So everything we're talking about on the left. In addition, let's shift to web traffic. There's App Store and there's web traffic as well. So how many people are visiting websites related to Zillow? 107 million unique monthly viewers. So this to us says that Zillow is a premier internet asset. I list down some of the monthly visitors on other sites, and here you have like Facebook and Disney and Twitter and Netflix, some of the better media assets out in the world. And Zillow is smack right there. And how we think about that is then you start to compare and contrast kind of what people are paying for those assets relative to what they're paying for something like Zillow, meaning what we're looking at on this slide is the market cap or the enterprise value of these businesses relative to the amount of users they have on their platforms. And when I say users on their platforms, I'm trying to focus on the US user. So when you see adjustments there, we're focused on the US user on these platforms. That's why in some cases we couldn't use other comparables. solely due to the fact that we couldn't break out how many of their users were essentially US, what share of their revenue comes from that US users, therefore what percent of that market cap is likely to be from US user, and valuing that alone. But what you see here is pretty telling. People are paying $70 for each user that visits, each monthly active user that visits a Zillow branded app. Um, Compare this to Facebook, where it's 1,700, or Netflix at 1,200, and Match Group, which is Tinder and some of the dating apps, which is in some ways a little bit more comparable, 1,600, and then Twitter, which historically has been known as a poor monetized asset, but still a really good asset, internet asset that is at 550. So there's kind of these 6, 7, 10x valuation, in many cases more valuation gap between what people are paying for a Zillow monthly active versus others. Now, I didn't share it, but they have 227, 230, 200 has been kind of the number over the last 4 quarters in terms of the amount of usage on their platforms. Putting it all together, we think, again, from the top down, there's a large cohort of buyers hitting the real estate industry. Of that, many of them are already engaging digitally, and as their purchase habits continue to evolve and grow, we think, again, the real estate industry historically has been mostly offline in the way it's transacted, and a lot of what gets done from discovery to closing. Now, a lot of that, in our opinion, will move digitally. And when we say digitally, we don't literally mean I sit in my room and purchase a home digitally. And in some cases, that's already happening, right? 1 to 2% of the market is being sold in that manner through iBuyers. And again, that was the business that Zillow was in not too long ago and got out of it. But you have some of the other players that still exist there and doing fairly decent well in those areas. But we do say or think that digital or real estate assets and tools will continue to move into those physical environments to try to assist, whether again showing time and the touring, setting up the tours, the CRM to communicate, whether it's marketing tools, and that's more of like a commercial product that the agents use as opposed to just selling them lead generation. Whether it's the closing services and really using that as a commoditized tool and offering that as a service to agents, and so many other things that could exist in such a large market that is $1 trillion plus. It's US focused, it's the leader in the space. We think there's a lot there. And then again, when you just apply the $70 that's being paid for each active user of the brand relative to the others, we understand that it's under monetized today, which further monetization could lead to further valuation enhancements in the company. And it's a pretty big deal. So that's kind of the nuts and bolts of the story. On this page, we highlight in kind of quick hits of the people, the growth objectives, the valuation, the product, the financials, and why we like it. Again, some of the similar things we've said before. Now, one thing I do want to pinpoint here before I move on to the next company is the financials. Their core business, their Zillow, a kind of premier agent business, which is lead generation advertising. First and foremost, they're roughly only like 9 to 10% of that real estate budget for agents. But this business is seeing 40+% margins. COVID did accelerate the adoption and usage of some of these tools. Housing prices also help as well. And here's a company that's doing $800+ million in EBITDA, of which the company's being valued somewhere in that $16 to $17 billion range. So we think you're getting a premier internet asset in a large business that we think has structural tailwinds over at least the next 5 years, where the product is under monetized and undervalued relative to other high quality internet assets. Zoom is another new name. Here is a company that again that prospered during COVID, and again pre-COVID it was a tool that was used, but it wasn't used as regularly. We have known Zoom for a while, and Eric Wan, again, we've known them when they were private, and some of the SaaStr events. He would speak a lot, and again, they were this fast-growing unicorn that was developing and growing. And again, he's been incredibly well known. He was on some of the founding teams at like WebEx and things like that. So he's a veteran in this industry. He's a product guy that has really done a fabulous job at building this business. Now uh, the evolution that's taken place over the last kind of, I'd say, 2 years now, right, since like the heart of COVID, is the brand recognition for this business. I think that's ultimately what's changed a lot. I mean, people knew what Zoom was, but Zoom is the verb in this industry. And in some cases, that's fine, that's good, and that's a competitive advantage. In some cases, it's not. I think it is a competitive advantage in this industry. In addition, reliability is all that matters. It needs to be a reliable tool. Now, when you step back and you think about the industry tailwinds, here we're showing on the left side Google search trends. So remote jobs, the amount of people searching for remote jobs, as early as a month ago, was hitting record levels. In addition to that, there's different stats that we know about. So things like Glassdoor. So based on Glassdoor's data, 20.4% of employers hiring locally in October of 2021 are competing against remote jobs, and that's almost double from 2019. So companies are going in, hiring remotely, and are hiring for remote jobs and trying to increase the pool of talent that they can pull from. Obviously, we all know about unemployment rates and the battle for talent, and ultimately what that means even more is remote jobs will have that natural tailwind as well. On the right side, you see knowledge workers. How many knowledge workers? And a knowledge worker is essentially someone that's not doing something in an industry that's focused on manual labor. Now, there's 100 million in the US, there's a billion globally, and you take these two stats together, and what you get is essentially a lot of individuals that have to think and communicate and interact with potentially their colleagues. But in addition to that, you have the amount of remote work. And the remote work is important because even if it's 10% of a workforce or 20% of a workforce, like of a company, ultimately what that means is for those companies to have their monthly sessions, for those companies to engage with other companies across their industry, the more remote workers inside of an organization, and again, it doesn't have to be 100% remote, it only has to be a fairly small portion, that creates that stickiness of these products. And we're seeing that more and more. There's been multiple businesses, again, that have committed to be fully remote. There's also plenty of businesses that are doing some form of hybrid. The 5-day work week inside the office, I mean, conceptually for me, doesn't make sense. It's all about productivity and how you can produce a product. Taking you a little bit deeper into their product. So Zoom is really well known for clearly Zoom meeting, right? And just those one-on-one meetings, and that's fine. Now, I think the most important thing here is what's next. And that's always been the case for us. So if you think about Zoom and actually the valuation of this business, and that's kind of away from the product, is pre-COVID it was at a certain level. Today it's actually at COVID levels, right? Like pre-COVID levels. And it's pretty fascinating to think about that. How close it is to like right around those COVID levels, despite all of the growth and traction that they've seen. And I think some of the fears around the business are essentially the competitive threats from Microsoft Teams, Google Workspace, and then some of the others. Yeah, even if it's Citrix WebEx or Cisco WebEx, I think again, viable threats. But what we've seen, just starting on the right, is 366 million downloads in 2021. Again, this is not 2020, this is 2021. 366 million downloads of the Zoom app. That compares to 173 of Teams. Still the #1 business app in 2021 downloaded. And what we did is we looked at what was last month's app downloads of the app relative to 2019 same month. And what we saw was it was plus 600%. So while obviously it's not at that peak like March, April, May, June of 2020 in terms of the engagement and levels, and it shouldn't be, and no one should expect that, and if that shouldn't be any sort of base case, but we're at plus 600% kind of 2 years away from the crisis relative to the 19 levels. I think that's a pretty important statistic to understand, and the 366 for the year in terms of million downloads, I think it's pretty important. Now, For us, what gets us excited is the amount of traction that they're seeing and potentially going to see across the other products. So things like Zoom Phone. I think telephony is a big area, um, and it's also an incredibly sticky area. So they periodically share some of the engagement that's happening there. I think the last one was either 2 or 2.5 million customers seats are using Zoom Phone. They have up to 38 customers, I believe, using that product today. And again, it's a product that is rolled out company wide. We've seen some Fortune 500 companies and plenty Fortune 10s that have engaged with that product. 512 customers are using one of their products with 10 or more employees. So they have a massive user base of companies or audience, right? And ultimately what that means is this is what they take this Zoom Phone, their Zoom events, their Zoom chats, their Zoom rooms, and anything else they create beyond this, including contact center, customer support, and things like that. Where that is the audience and customers that they can sell into. So trying to attach Zoom Phone and some of the other products and upsell that, we think is most of the future growth there. It's also highly profitable, obviously, as their meetings product renews. It costs them very little to make that renewal sale. But in addition to that, everything is focused on upsells. Now, looking at the size of these markets, again, I think what you've noticed here in the last two is that the end markets are large, and they're best-in-class products, best-in-class downloads. All of the actual tailwinds flowing to the leaders in this space, and Zoom is no different. We start to look at, okay, if they start to engage with, again, some of the adjacent markets, whether it's telephony, like I said, with Zoom Phone, only 4% of their accounts are using Zoom Phone. Again, 30 customers with 10,000 users or more are using it. That's a 20 to $30 billion market where they're just at the tip of the iceberg there. Webinars and virtual events, obviously they announced events, which is to become a more complete package for event related products. It's not a huge market, but it is a market that obviously makes sense for them. Contact center. So they tried to make the acquisition of Five9, that fell through, and they're here trying to, or they're going to create their product here and launch it in 2022. So really becoming a communications platform, and then collaboration and chat and things like that. I do believe at a high level they need to continue to expand their product portfolio, and doing so in a way that is creates much more of a platform solution, and again, chat and messaging and things like that, almost like Slack like functionality. I've been banging the table that they should go out and buy an email service. There's some pretty interesting smaller ones that aren't necessarily Outlook or things like that, or Gmail, that are pretty interesting, that would make a lot of sense for them. Now, when we think about the kind of 6 pillars here, the people, obviously best-in-class leaders, the growth objectives in terms of attaching new products, really the knowledge workers times the amount of remote work leading to explosive potentials in attach rates, which obviously highlights that today's valuation is fairly cheap. The amount of customers they have, and if they get those attach rates on Zoom Phone to 20, 30, 40% of their audience, along with contact center, we just believe that Zoom is in a pretty strong position going forward. Next one is Fiverr, and this is the third of kind of the or the third and last, I guess, in a way, of the newer positions at the company. We've been in contact with Fiverr for quite some time, and it's a incredible company, incredible product. We're users of it, and it's something that we appreciate. Mika Kaufman is the founder, CEO. He has been doing this for quite some time, and this isn't something that is brand new in terms of a 5-year-old company like a Snowflake or anything like that. It's a company that's been around for over a decade. It's pretty interesting. Now, when we think about the tailwinds to this industry, you can kind of pull back to Zoom and get the remote work and jobs and use that as kind of our thought process. And that's part of the tailwinds that's taking place here. But in addition, it's kind of that creator economy that's being embraced today, where people have, because of the digital solutions that are out there, have that ability to really ultimately create their own destiny. And Fiverr is one of those platforms. In addition, it's the other side of it, which is the companies, where they're trying to find jobs or trying to find people to work and do certain tasks. And what Fiverr is essentially doing is breaking up those job functions into the tasks. So if you are a marketing professional inside of an organization, maybe you're just really good at graphics, or 3D rendering or logo design, and using like a freelance platform such as Fiverr, you can just specialize in that and kind of make your career on that, as opposed to doing everything else that's associated with that job. Now, what we show on the left is how costly and why a platform like Fiverr even exists. Is there's barriers to entry both for the employers, to find freelance jobs or find jobs in general, meaning it's hard to find somebody. You go through the process of exploration and the hiring process. That's time, money, things like that, and in some cases, there's no proof of work prior. On the freelancer side, trying to find your next job really requires uh, consistent marketing, but you're doing this to make money, not to be a marketer of a single person entity. And what Fiverr stands to do is essentially be that marketplace to create demand for the freelancer, and provide actionable freelance workers for the businesses. That's a pretty powerful marketplace. The beauty of it is it doesn't compete against someone like a um, Amazon or things like that. Now, who it does compete against is someone like a Upwork, and then we show on the right. So Google search trends. This is as of several days ago. We did a complete sweep of app downloads and search trends and web traffic of 2021. We did this here within the last week, first week of 2022, and pretty compelling chart here is where Google search trends for Fiverr versus Upwork, and there's this massive divergence that's taking place, where the search trends for Fiverr are going parabolic, and it's pretty interesting to say the least. So those are some of the trends that are taking place. Now, the product, for those that don't necessarily know Fiverr as well, it's a marketplace for freelancers. 4.1 million people are on there buying freelance work, meaning someone going out and saying, hey, I need a logo. So they type in logo into the search bar, and things like you see on the bottom right are the results. And what you find is an offering page, right? So similar to what you would see on Amazon when you buy a product, this is productizing freelance work. And I think that's pretty special and different. Instead of what it does is you get a review, you get a rating, you get prior work, and you can quickly make a decision, know your price ahead of time, and remove that burden of not knowing what you're going to get and what you're going to pay for it ahead of time. Some of the other platforms do it on kind of like an hourly basis or a project basis, and there's some friction in that. So Fiverr, what they do really, really well is remove some of that friction. Now, what that has done, obviously, is it created the average spend per buyer is slightly low, or is lower relative to like an Upwork, and part of that is because of what I just said in terms of it's not like these large scale negotiated projects. It's much more projects that have a certain price and much more fast paced. Now, 33 million downloads since 2014. That's a lot of downloads, but the more interesting part is 30% of those downloads happened last year. And again, that's fantastic. The other part of this, where I think is fascinating as it goes forward, is they launched Fiverr Workplace. So while there's a small percentage of freelancers that that work online, most of it is like 95% of all freelance work is in the physical world, right? So I told you that this person is good at logo design. They call you, you guys negotiate whatever happens and email back and forth, and it's all offline. Email, you're doing your email, but it's not through some sort of marketplace, and the whole experience is digital. The what they're trying to do is connect the offline and online freelancer so that they have a place of work. So Fiverr Workplace is that, where you can invoice people in the offline world, but still have your Fiverr online page. Maybe you direct people to your Fiverr online page so they can see what the quality and type of work you have. But really being that central CRM slash marketing slash business platform. It kind of reminds me again of early days Square and the way the Square point of sale was. This is kind of like that digital point of sale for freelance. And that's pretty fascinating. And a couple other things that have happened in the near term. We did a lot of work around trying to understand the size of this market. And what we did is we took the US Census, we went through it, and we concluded that there's roughly like a $23 billion revenue opportunity. The company says 100 billion, some others say 150 billion, some say 70. So we're obviously clearly like on the low end of all that. But what we did is we went through every single job that exists and try to gauge using probability of that job moving to freelance work. So again, the thesis is, if let's say you're making $1 million a year doing software and coding, like you're not going to go on to Fiverr and try to do side projects. I think just the probability is much lower. Someone that does radio hosting and maybe doesn't get paid that much, and does that, can take that voice, because clearly it's their voice that is in theory magical, that they can use that for voiceovers and other types of voice related topics and become a freelancer. Higher probability for that person. So then we took that times the probability times the amount of salary that that job creates, and that ultimately gives us the potential for the size of that market. We also adjusted for other stuff in terms of like what's the probability of them even becoming a freelancer, even if their job is low paying and potentially well suited. So there was adjustments on adjustments on adjustments, and we came to a 23, $24 billion kind of market size in terms of revenue. And ultimately, what kind of share could they extract from that? And for us, we think, again, as a leader in this space, they could probably extract 30, 40, 50% of this market over time, specifically if they start capturing a lot of that offline market. But today, we think a lot of that is not baked into this business. And we think, again, it's worth multiples from here. We highlighted on the valuation side on this page. Strong financials. So what we love about them as well is that they use a pretty consistent and rigid process of how they spend their marketing dollars. And I think that's pretty important in terms of they use what's called TROI, time to return on investment. They actually break even on every dollar they spend on marketing in 3 months. So they probably will extend that out over time, and very similar to a company we invested in the past, Wix, another Israeli-based company, and that's Fiverr. Now Capri, this is well-known company for us. Obviously, we've owned it for a little bit. For us, Capri is obviously led by John Idol and has the lead designers. I think that's really what separates them. Everything from Donatella Versace, leading Versace as a designer, Michael Kors leading Michael Kors, and Sandra Choi leading Jimmy Choo. Luxury is moving online. 70 billion happened online in terms of luxury sales. That's double from 2 years ago. The luxury definition is changing. It's going from kind of like status to self-expression. It's going from kind of brands to kind of social influence. And we think a lot of that is pretty interesting and sets up well for the larger luxury houses. Now, their product is fairly simple to understand here, but it's much deeper than that. So Versace, Jimmy Choo, and Michael Kors, we do know that obviously they're going to be acquiring more brands in the future, and becoming kind of this mini LVMH. And we think, again, they've executed wonderfully. There's multiple drivers here for them to grow. Obviously, it's the business itself. They're seeing strong margins, cash flow generation. They'll make an acquisition. What they do when they acquire these businesses is really, look, they're really good at sales, and they're really good at storytelling and brand affinity. They have 50 million social followers across their platform. And that's how the fashion industry is moving. It's influential. Now, there's obviously other adjacent things that we don't even incorporate in any of this stuff, which are the metaverse and marketplaces such as NFTs, where brands can utilize their brand as some sort of asset in those spaces. That's not something we're even considering here. We're focused on two things: is really margins and growth and multiple expansion. We think Capri continues to have that combination of multiple expansion and likely somewhere around $7 a share in earnings power over the next couple of years, which again, if you take even below some of the high end luxury peers, anywhere from a 20 times multiple and 2 years out on a $7 earnings power, you get a pretty successful investment outside of what has already actually transpired. That's $140 a share at a couple years out, which is not even base case. So I think that's a pretty interesting company, obviously, and again, we've spoke about it a lot in the past. And again, here's the people growth objectives and everything. This is a powerhouse at this stage, in our opinion. Nutanix. Nutanix for us, again, is another transformation story. Capri was the other one, very successful transformation that took place and is still taking place. And then we think as time goes on, it'll warrant even higher. Rajiv, he just came over from VMware, where he led a couple big units of that organization. Dustin Williams has been around for a while, and he's actually led multiple companies public and has actually successfully transitioned the economic model at Nutanix. Two large tailwinds. So here's a survey showing where CIOs expect to spend or have their workloads in the coming years. And ironically, so more are planning on moving their workloads on-prem and away from public cloud, which is pretty interesting phenomenon in a study that was done. On the right side, Andreessen Horowitz basically had a letter that they put out, basically highlighting how companies, specifically the ones that they've invested in the past, have totally wasted a ton of capital on public cloud spend. And if you remember, Andreessen Horowitz has always been a leader in software and public cloud in terms of their investments. And then so coming out with this piece was pretty interesting, to say the least. Now, what was highlighted was actually how Dropbox shifted from public cloud to building their own data center in a sense, and private cloud or managed hosted data center, and they saved $75 million over a several year period, and that was from 2014 to 16, which is probably multiples of that today. We know Zoom is moving away from the public cloud. We know Pubmatic is not even in the public cloud, and several others. I think people are starting to realize that as you scale up, public cloud spend becomes really expensive. It is important to have it for if you are a company that sells during holiday season. Your spend could increase pretty dramatically, or your data usage could increase dramatically, your servers, and you may need more capacity. Now, another tailwind for someone like Nutanix are so as multiple companies go to public cloud or using a single point of failure in a sense, they're realizing that they need to have multiple clouds. So it's whether it's Amazon and Google or Microsoft, their own data centers. What we're seeing is if you have it in one place, you're at risk, obviously. AWS over the last month has gone down several times. So if you're just only on AWS, you're probably rethinking how to reconfigure your data center and probably have Google and Amazon or something like that, or your own and Amazon. And what that does is set up a software like Nutanix to be well positioned to be a single platform that allows you to manage across multiple clouds. And I think, again, one part of the Nutanix story is they've made multiple shifts over the years as it relates to going from hardware and software to software only. Then you had the economic transition where they went from subscription to selling licenses over multi-years to subscriptions, and and shortening the time of their subscriptions. And that's led to a lot of confusion and dislocation, what we think in terms of the fundamentals of the business and the underlying stock. And again, these are some of the better things that or some of the more fruitful um, things that happen that can lead to pretty nice rewards over time, assuming you can find them and understand what transitions taking place. So what we know is, again, as complexity gets bigger, as people move away from Amazon and need to move to Amazon plus other clouds, it becomes more complex. They can go out and choose different vendors, whether it's hardware, different hardwares and softwares. They're going to need a centralized place to manage all this, and that's where Nutanix falls in. What we love is we can kind of say, okay, Nutanix is well positioned and this or that, but the reality is it's the data that really speaks. And 2,700 or 20,700 customers, 90 net promoter score over the last 5 to 6 years. Gartner and Forrester put them in the upper quadrants, highlighting the success of the platform and the vision. And 17.7x is the purchase multiple. So meaning if someone spent $1 day one, they are now spending 17.7 times that over time. And I think that speaks to people liking the product, more customers, spending more. And I think ultimately that's what is the what's going on here. Now, similar to Capri, it's about credibility. It's once you establish that credibility, what we're going to see is see multiple expansion. These are large markets for them. And they've already announced, obviously, that they expect to grow roughly 25% over the next 3 years. They're already on pace for that, and the CEO came out yesterday with the 7 plans and kind of acknowledged that they're still on track for this 25% growth over the next 3 years. Which, if you just take that number, that means the business will at least double in terms of revenue or bookings capacity for this business. So again, we like that it's a misunderstood story that's giving us the ability to invest, and their product is best in class. Lastly, Omnicell. We've talked about Omnicell in the past. It's been a hold for us for 4.5 years. Founder-led, Randall Lips. It's been there since, obviously, he's the founder. Peter has been the CFO for quite some time now. Industry tailwinds is there's a lot of issues in terms of medication management. This is a medication management company. There's 25,000 errors annually in hospitals. There are 47 million doses lost to drug diversion. There's so many issues, and that's increasing costs and impacting outcomes. The platform itself, again, you see on the bottom there is a lot of the hardware that they sell. But then they have Omnicell One and some of the software tools that they're building on top of that. So a lot of those hardwares, they're roughly like 50% of the market as it relates to the XT dispensing cabinets. And they continue to build out a robust platform of products that's then being attached now, probably over the last like 12, 18 months, to their software platforms, which again is also assisting their economic model because it's more reoccurring. They have a massive install base. They have over 50% of the top 300 hospital systems. Of those, they have 10-year sole source contracts with many of them, or most of them, which means it's highly repeatable model in terms of visibility, in terms of future growth. As it looks today, look, we've been in this business since it was a $500 million revenue business. It's 1.1 today, with a target of 2 billion over the next several years. We think, again, from its growing margins, growing revenue, it's the clear established leader in the space. And we think, again, conceptually, it's a very, very attractive business that's growing in a fruitful way. All right, so I hope that gave you a good perspective on some of these businesses. Again, we went into some detail in terms of the overarching rationale why we own these businesses. From the industry tailwinds that exist to the rationale or leadership talent that many of these businesses have, why we think there's value left in these companies. In many cases, it's a dislocation of what's happening in the business. Again, if things aren't perfect, typically investors in public markets will run away. which is arguably why we have a long-term mindset. We're looking 3, 5, 7 years out. And what we want to articulate here is essentially many of these businesses have key characteristics we're looking for, either dominant positions in their industry, a product that's evolving and expanding where the market doesn't realize, and many other factors, obviously, such as valuation. That's really it for part one of company thesis, and we are looking forward to share part two over the coming time.